Before we begin, this video is only for educational purposes. In the next few minutes, you're going to understand one of the most shocking and fastest market crashes in modern history. A moment when the global economy froze, entire industries stopped overnight, and the stock market fell harder and faster than even the 2008 crisis. You'll learn exactly what caused the 2020 COVID crash, how it unfolded day by day, why investors panicked, how companies like Apple, Amazon, and Tesla reacted, and how the market recovered in a way nobody expected. By the end of this video, you'll understand not just what happened, but also why it matters for your long-term investing journey. So stay with me because this story teaches one of the most important lessons every investor should know. Welcome to Crypto Brain Power, where we break down stock market history, the evolution of financial markets, and long-term wealth-building concepts in a simple and beginner-friendly way. Our mission is to help you understand how markets work, why they move, and what lessons you can learn from some of the most important events in financial history. The COVID crash of 2020 was unlike anything investors had seen before. It wasn't caused by a financial bubble or a housing crisis. It wasn't the result of bad loans, corporate fraud, or overvalued tech companies the way it was during previous crashes. It was caused by a global health event that forced the world to stop moving. And when the world stops, the economy stops with it. That fear alone was enough to shake the stock market to its core. In February 2020, the S&P 500 was at all-time highs. Companies were reporting strong earnings. Unemployment in the US was near historic lows. And then news started spreading that a new virus was moving across countries faster than expected. At first, investors hoped it would stay contained. But within days, countries began reporting rising cases, travel restrictions, and early lockdowns. The US market reacted instantly. In just a few trading sessions, uncertainty turned into fear. By late February and early March, panic selling took over. The Dow Jones suffered multiple thousand-point drops in a single day. Circuit breakers, which are emergency market halts designed to calm panic, were triggered 4 times within 10 days. This had only happened once before in modern history. For many beginners investing through platforms like Robinhood, Fidelity, and Charles Schwab, it was the first time seeing this level of volatility. Why did the crash happen so fast? The answer is simple: uncertainty. Investors had no idea how long the economy would be shut down. Airlines had empty planes, hotels had empty rooms, restaurants closed their doors. Supply chains broke. Even massive companies like Apple warned about production delays. Tesla temporarily halted its factories. Amazon saw huge demand but struggled with logistics. Every part of the economy was being tested at the same time. The Federal Reserve stepped in quickly. They cut interest rates to near zero. They launched massive stimulus programs to support the economy. The U.S. government approved relief packages, unemployment support, and business programs. Normally, these kinds of measures take weeks or months to create market stability. But in 2020, the reaction was immediate. These moves didn't stop the crash instantly, but they calmed fears and helped set the foundation for recovery. One of the most surprising parts of the COVID crash was how fast the rebound happened. After bottoming out in March 2020, the stock market began climbing again. By August, the S&P 500 was back at new all-time highs. Tech companies led the recovery because people were working from home, shopping online, streaming entertainment, and relying on digital services more than ever before. Amazon's business surged. Apple shifted to remote product launches. Tesla's stock entered one of the strongest bull runs in its history. However, many beginners made mistakes during this period. Some sold everything at the bottom out of fear. Others bought extremely risky stocks believing the market would make them rich quickly. Some people followed hype instead of learning how the market really works. These mistakes usually happen when emotions control the decision-making process. The biggest lesson from the 2020 crash is that markets can fall sharply, but they can also recover strongly. Crashes are part of market history, but so are recoveries. Investors who stayed calm, understood risk, and maintained a long-term mindset were able to benefit from the rebound. Those who panicked often locked in losses. When studying events like the COVID crash, beginners should remember a few simple ideas. Markets react to uncertainty. They move based on fear and expectations. Short-term volatility is unpredictable. And most importantly, long-term investing works best when you stay consistent and avoid emotional decisions. Whether you invest through platforms like Robinhood, Fidelity, or Charles Schwab, Your strategy matters more than daily price movements. As you continue learning about the stock market, historical events like this help you understand how strong and resilient the market can be, even in extreme situations. The COVID crash was a reminder that the world can change overnight, but long-term investors focus on years, not days. If you enjoyed this breakdown and want more simple, educational videos about stock market history, market behavior, and long-term investing lessons, make sure to subscribe for more educational videos. Educational purpose only, not financial advice.